I'm sorry, there seems to have been a bit of a technical difficulty. It sounds like there was a delay to the broadcast. So sorry for that inconvenience. I see that some of the attendees did ask the question. So I think if you don't mind, let's have just a quick recap on where we are. So for everybody who's just joined us today, this is the 12J Investment Opportunity webinar with Geltech's experts, Gairof Nair and John T. Sachs, and this is the Infinity Anchor Fund that we're talking about. And we've just had a bit of an overview about the founders, and we heard that John T. actually has a legal background, and Gairof, you've got an extensive background in financial services. And we were just about to start hearing some of the details about the fund. So if you wouldn't mind, just, well, somebody's saying, sorry to do that, there's still no sound.
Sound is coming out clear on our side, even on live stream. If everybody can just check their internet, please.
Okay, brilliant, thank you. So, sorry, let's just crack on there. So you were saying that, can you see the slides now?
I'm seeing your desktop background.
Okay, let's try and open that. Can you see that now?
Yes.
Okay, brilliant. Sorry, so you were telling us that the underlying details of the fund is that it's underpinned by asset rental investments.
That's right, that's right. So we end up taking equity in businesses that themselves have asset rental businesses. And by their nature, these businesses have a lot of assets on their balance sheet. The assets they're renting out. So they have a lot of value there, and they have contractual cash flows that they're earning from their customers, regular cash flows. Jackie, I think the slides have disappeared again.
They disappeared.
Yeah.
There, can you see them now? No.
No.
There we go. It's on. Okay, no. Sorry. Okay.
No worries. So there's kind of a regular cash flow, a steady cash flow stream that all these businesses earn. And what this also means is that as a fund, Infinity is able to exit these investments quite easily because of the nature of these businesses. And that means that for our investors, we can give them certainty of exit. Some funds, they only invest 80% of their money. And this means that 20% of the cash is sitting and only earning interest. But it also means that they're running a risk because 80% is the bare minimum to be a compliant fund. So we target investing 100% of our capital and have a good track record of doing that. And finally, we charge our performance fees on gross capital. And what this means is that it's only on how much we grow the investors' funds. Whereas a lot of fund managers in the 12J space, they also charge a performance fee on the tax benefit the investor gets. And this means that the performance fees are very high and it erodes investor returns. So that's not good for the investors. If we can go to the next slide, please, Jackie.
Sure. There we go.
Perfect. At Infinity, we spend quite a lot of time and effort on risk mitigation. All the investments we make require a co-investment by the entrepreneur that's running the business/management team. And they have to invest between 15% to 50%, depending on the riskiness of the business. And the entrepreneur's investment, that acts as a first loss. And what that means is that if for some reason there are adverse events and the capital base of the business we've invested into is eroded, it erodes only the entrepreneur's capital first before affecting Infinity's investors' capital. We also have a contractual step-in right. And fortunately, we've not had to use this, but what it is that if things are going badly and part of the first loss is eaten into, then we have a right to take control of the company, appoint the majority of the directors, fire the managers, etc., and try and salvage the situation. So this gives us the right to actually intervene in the businesses if things are not going well. Further, our investment gets preferential dividends. This means that the first profits the business makes goes back to our investors, and thereafter, the co-investor, the entrepreneur management team, they get dividends. And finally, speaking about exit in the last slide, we have a liquidation right, again, contractually. And what this means is that with the entrepreneur, unless we agree on a credible exit plan, whether it's a bank coming in to lend money or another buyer, we have the right to force all the revenue coming into the business out as dividends. And so in this way, we can recover the money from the rental contracts and return it to our investors. I'd like to highlight, yes, sorry, Jackie.
Sorry, continue.
I'd like to highlight a few investments that just to give you a sense of the type of investments we make at Infinity. So the first is a business called Executive Mobility Financial Solutions, or EMFS. And this business is run by the ex-CEO of Mercedes-Benz Finance South Africa. They've been in business for 8 years, but the senior managers have more than 25 years of experience each. We invested 20 million Rand with them. And what they do is they do long-term rentals of luxury cars to corporates and individuals. And what we saw is that even during COVID, they had an experience of bad debts not increasing, of people still paying timelessly. And so they are servicing a sector of the economy that was not affected by COVID and lockdowns, etc. And so seeing that it's such a robust business, we invested with them in December of 2020. But in addition to the usual risk mitigation, we also negotiated with them that they have to guarantee us a yield of 9.18% per annum, and that's excluding the tax benefit to the investors. This one here is called Doline Investments, and Doline has been in business for about 18 years. And over the 18-year period, they have had revenue every year in the hundreds of millions, but their combined losses have been in the few hundreds of thousands over the entire period, which is really an amazing stat. Also quite immune to COVID, we saw in their experience. What they do is they rent out cars to car dealerships, and they play in the 100,000 Rand sector. So these car dealerships rent out these cars while they're waiting to sell them. So while it's on the showroom floor, and you know, they have great expertise in risk mitigation, and so we're expecting a very good return here. We're expecting about 12.6% per annum, again excluding any of the tax benefits, and with the usual risk mitigants that we spoke about. Now, a couple of the investments that we made a couple of years ago, so to see how some of the older investments are doing. We invested in a business called Securitas. They rent out security technology, such as cameras, electric fencing, etc., to corporates and complexes, body corporates, etc. And what they do is they rent out this equipment, but it's often packaged together with other services. So a security company will be monitoring the cameras, for example, or provide armed response if the alarm goes off. Again, we were already in this business when COVID hit, but we saw exceptional performance. As you can imagine, corporates and complexes, etc., security is one of the last things that they will default on. They wouldn't want someone to come in and take out their alarm systems, etc. So we had 0 bad debts to date, even through lockdown and COVID, and returns have been healthy at 9.73% per annum.
It's really quite striking, these very interesting companies that are operating in South Africa below the radar.
That's right. That's right. I mean, all of these businesses, they have some kind of unique aspect to their business model that allows us to earn healthy rental yields. And Ryze is also very characteristic of that. So Ryze is a business that does the development and ownership and management of fiber networks, and they provide this to residential areas. And as you can imagine, with lockdowns, people being at home more, they video conferencing more, consuming more Netflix and so on, the demand for high-speed internet access went through the roof. And so Ryze has performed very, very well. We invested 21 million Rand with them in the midst of the lockdown in June of 2020. It's been doing well. And in fact, they've been growing so well that we have the right to a follow-on investment, which we'll be likely to make for another 20 million Rand.
Seems like the COVID-19 lockdown was good for your portfolio.
Yeah, it has been. It has been. And just to talk to you about some of our performance results. So, you know, Infinity's 2019 investors, for example, they have enjoyed an average dividend yield of about 5.1%. And the investors typically that go into Infinity, they like to get a dividend flow, and we've been paying that dividend every 6 months. Net, this is taking into account the tax benefit. This is equivalent, the 5.1 is equivalent to 9.27% when you take into account the tax benefit. But ignoring any of the tax benefits, the total return with dividends and growth in capital has been 5.22%. When you take into account the tax benefit as well as any exit taxes, all fees, etc., it comes to about 15.35% as a projected return, and we have 100% of capital invested. And now I'd like to talk to you about the pipeline of businesses. So in essence, when we went into COVID in March of last year and businesses went into lockdown, what we did was we had about 350 million Rand of businesses that were in our pipeline that we were ready to invest into. But the board decided to hold off on that and look at how these businesses now perform in this new environment because things had changed. And we added an extra criteria. And that extra criteria was that we wanted to see these businesses keep performing well during COVID. And what we also saw is that some businesses that didn't perform well, we ended up not investing in them. But we also started to see some really nice businesses that we believe in the past we would not have had access to. And the reason that we think this happened is that these businesses, they found themselves performing well and needing more capital for growth. But where they had facilities with banks, etc., these banks, feeling nervous about the new environment, did not extend new facilities to them, even though they'd been paying perfectly on time, etc. And so we started to see really good opportunities that were willing to accept our more expensive capital than compared to banks, for example, in our pipeline. And hence the quality of the pipeline improved greatly over COVID, far from reducing in quality as you might have expected. So here's a snapshot of our pipeline. In total, there's 28 companies in it, and everyone asks for a range. So there's a range of 350 to 500 million in total in our pipeline across a number of sectors. And the return profile, excluding the tax benefits, is somewhere between 10 to 25% across all these businesses. And most of this pipeline is exclusive to us. We've signed exclusive contracts with these businesses that we have the right to fund them, and only if we turn them down can they go elsewhere.
So COVID-19 stress test all these businesses for you. The bank said no, and you've got very nice underlying assets now.
Yeah, and you know, Jackie, the thing is that some of it wasn't our genius. Some of it was just good luck in terms of timing. We had all this money that we raised in February. We were about to invest it, and then March, before we could invest the money, COVID happened. And a lot of companies in our pipeline then were removed from the pipeline because their experience was actually quite terrible during COVID. So what we have here in front of you is, in fact, a new, more robust pipeline of businesses that did perform well during COVID.
Thank you.
Sure.
And now should we move to the financing options, John T?
Yeah, so you know, what we realized as a business that with Section 12J not being extended, there'll be a lot of investors who, you know, in and around June, they're aware of either a PAYE obligation that they've been paying every single month, or potentially they have a capital gains tax event happening later in the year or already in the year, and need to make a Section 12J investment, but simply they won't have the capital. So what we did as a business, and we worked on it for a long period of time, we raised money in a separate fund in a national credit regulated entity, and this has allowed us to now fund investors into Infinity Anchor Fund. So now, for example, if a client or investor doesn't have capital, all they need to have available in June is 5% of the investment value. So let's assume for a moment someone needs to invest R1 million. All they have to do now is invest 50,000 Rand. We'll fund 950,000 Rand. They'll receive a share certificate to the value of R1 million. They'll be able to claim a tax deduction within this financial year of R1 million. And then, like any loan, there'll be an obligation to repay. But I think what's really interesting about this opportunity is if you take the funding option now, your interest rate from now till October 2022 is only 4%, and that's fixed. October 2022 is a very relevant date because that's when a taxpayer will receive a refund from SARS. They'll then use this refund to pay back a portion of the loan. So they'll have to make a 45% contribution in October 2022, typically the tax benefit that someone receives. So now, in the example I gave, the investor's balance sheet goes to R500,000. So the 50,000 Rand that they contributed, the 450,000 Rand from SARS, they now have an asset on the balance sheet of R500,000 Rand, which is really funded by SARS. They will then have an obligation to repay the loan over the remaining term. The interest rate does go up, but fundamentally, the investors are using SARS's money to make an investment, and that has a huge impact on the returns. So much so that if Infinity Anchor Fund continues to do what it's been doing in the last 3 years, and that's really providing consistent, moderate returns, investors with a tax benefit will potentially achieve a return of 26%. And that 26% is, it sounds extremely high, but ultimately it's supported by the tax benefit and the fact that the investor is using or getting a return on money which is really not theirs. Or they've already paid the tax and they're receiving a refund from SARS. The dividend payments that Infinity's been paying will go towards paying interest and some of the capital, depending on how much the investor has put down. But it's a really nice funding mechanism for taxpayers with a tax problem. And accessing the capital is really easy. It takes us within 24 hours. It's a simple application process, which a taxpayer would have to go through. And we've already written millions of rands worth of investments for our June investment through this funding mechanism.
Thank you very much, Jonty. And just to our webinar attendees, please do feel free to pop your questions into the question box. Jonty, is there anything else you'd like to add before we start taking some of the questions?
I think just if you look at, or if we just go over a couple of things that Gaurav said, I think, as a business, Infinity ultimately invests into two types of companies. Either companies that are asset-backed, and Gaurav gave an example of the car rental companies, the security rental company, or businesses that have contractual income. And for us, the contractual income has been really a great opportunity. We invested into Ryze Telecoms. That business obviously sells data and it's done extremely well. You can imagine people are stuck at home. They've realized DSTV Netflix is a better alternative to DSTV, so data consumption has really gone through the roof. And we really started to see an overwhelming opportunity in this market, particularly because banks aren't funding asset rental businesses for whatever reason. So what Gaurav and his team are seeing regularly is businesses coming to us saying, we expect every year a funding line from the banks because we've been in business for the last 10 years. We have a great relationship with the banks and they've always given us funding. And all of a sudden, banks have taken a really risk-averse approach. But from our perspective, these are businesses that have an amazing track record and really tick all the boxes that we require. And as a result, our pipeline is really exceptional. And because Gaurav and his team work so hard on the pipeline, we typically never have a deployment problem. So if you compare us to some of our larger competitors, they're sitting on a lot of cash. And as a result, their investors are seeing much lower returns because of cash drag, where Gaurav and his team have been really exceptional at deploying capital into businesses that have done really well. Our results came out, I think, 2 weeks ago, and across all our vintages, the average return with a tax benefit is approximately 15%. Now, I can tell you, knowing the market exceptionally well, you will struggle to find a Section 12J investment that has come close. They might tell you that they're targeting 20 or 30 or 40 or 50%. None of them have a track record that Gaurav and his team have achieved. So, as a business, you can hear, we're really excited about this fund. We're really proud of it. It's done really, really well. And, for investors who haven't invested with us, this is a really good opportunity. We're obviously closing in June for good as a Section 12J fund because of the non-extension of Section 12J. So yeah, I think it's a really good opportunity. And lastly, Gaurav and I and my partner and many of our staff, we invested into this fund as investors. So not only do we have a responsibility to manage people's money, we're managing our own money because we believe in this investment.
It's always good to hear when the investment manager puts their own money into the pot, because then there's a shared interest in
Exactly.
making sure that the investment works. Thank you very much for that, Jonty. One of the questions that comes up often where you get investments with good returns is, what's the catch? Where are the risks? Why is your fund able to perform better than others?
Yeah, maybe I'll take that, Jackie. So I think one of the advantages of our fund compared to, say, let's say other funds that are maybe in a different sector, like investing in property, like some of the hospitality funds, is that they have dead time. So they have time when they're not earning revenue because they're building the property, for example, they're developing it. Of course, during COVID, they've suffered even more because of occupancy levels being down and so on. So fortunately, we don't have any dead time because we have a pipeline ready. Some fund managers, they have a strategy, but they have no pipeline. And so they raise money. After they have the money, they then go out and find the investments. But because we have a pipeline ready, for us to deploy the money quickly becomes easy, and we have none of the dead time involved in property development. So that allows us to earn good returns. And the other thing is, because we've been deploying well over a long period of time, we don't have a big queue of money. And so we can be very picky because we're not under a lot of pressure, and we can choose just the best opportunities that have the best returns. Whereas if there's a big queue of money that's been waiting many years to be deployed, then I suppose you have to be less picky and just deploy faster.
Thank you. Eddie has a question that's connected to that one. He wants to know, what are the worst examples of companies that you've invested in? So where have your mistakes been and how have you fixed them?
Yeah,
If you've had any.
If we've had any, yeah. Very fortunately, we've managed to avoid mistakes. As I alluded to, it wasn't any genius of ours, the timing of COVID. It was something totally out of our control. And there were some businesses in our pipeline that I was very crazy about. They had 12-year track records of great performance. And once COVID hit and we pressed the pause button, we then looked at those businesses 2-3 months later, and they had suffered serious impairments. And I don't know which fund managers out there could have called COVID, but I can say that fortunately we were able to dodge that. And if COVID had been 1 month later, we might have invested in that business and lost 20%, even though there was a good due diligence and so on. But hopefully in that scenario, our risk mitigation would protect us. Hopefully where the entrepreneurs to co-invest 20%, and so hopefully that would have provided some cushion for our investors. Chanta, I see you also wanted to say something.
Yeah, so I think just to elaborate on Eddie's question is, if you look at our investment mandate, we're not looking to invest into businesses that are going to give us a 20, 30, 40% return. We are looking at moderate returns, 5 to 8% to investor on an annual basis without the tax benefit. And we achieve this by looking at asset-backed businesses that generally already have funding from the banks. And then what we like to do is we like to replace the bank's funding. Now, why this is relevant is if we know that these businesses have been servicing a bank for the last 5 to 10 years, we're pretty confident that they can continue to service us based on our dividend requirements as opposed to an interest obligation. So why this is relevant is we don't feel that we're taking much risk because we are really replacing the bank with cheaper funding, or in some cases more funding than the banks are able to give because of Basel and other requirements. And as a result, we're not taking a significant amount of risk. This is just a healthy way for these businesses to raise capital. And fortunately, we haven't encountered, even if you look at COVID, our investments didn't grow enormously, but we didn't lose money. We grew a couple of % during really, really tough times. So I think the nature of the underlying asset here is that they are, from our perspective, really low risk investments. And just to add on what Gaurav was saying is we're not taking property development risk. We're not taking occupancy risk. We're not taking, tourism risk and, people being able to come into the country. That's not the nature of this investment. This is an investment that's going to yield a consistent dividend every year, as it has for the last 3 years. And we've paid out dividends for the last, 6 monthly dividends for the last 30 months, pretty much consistent. So the nature of this investment isn't high risk.
Janti, Jan wants to know, would you invest in the agricultural sector? That's one sector you didn't mention now. So
Infinity's mandate is really any sector as long as the business is in asset rental. So if it was, for example, the rental of tractors or a farming implement, then we would look at it. But obviously there are a number of key investment criteria which we consider. For example, is the entrepreneur going to be investing alongside us? Does he have a track record? What does that track record look like? What are the credit vetting processes? So we're happy with most sectors as long as the basic investment fundamentals are there.
Thank you. Jan has a follow-up question to that. He says, would rent to buy options be something that you'd consider?
So rent to buy so within Section 12J, this is just part of the law, you're not allowed to do financial services. And so the businesses we invest into, if they did rent to buy, that would be considered financial services and that would not be allowed. So what we have is we have a fixed term rental contract. Usually that term matches the life of the asset. But at the end of the period, the asset still belongs to the business we've invested into. And this results in 2 opportunities for extra return. because by that time, even if we got not a single another rand, we've already earned our return. But the one form of extra return is what we call second life, which is where we take the asset and we rent it out again, and now it's all profit because that's already paid itself off. The second option is what we call evergreen. This is where the customer has paid off the minimum term. So there's been a 3-year term that they had to pay rentals to us for, and now it's over. And they're not obligated to keep paying us, but they would like to keep using the asset. And so in this scenario, they keep paying. Sometimes in order to incentivize a customer to continue with an evergreen contract and just keep paying month to month, the evergreen rental is lower. So it might be half the previous rental, for example. And so the client keeps paying, and again, it's all profit.
Thank you. Victor wants to pick up on the issue that John T raised about that you can take out a loan and then when you get your refund from SARS, you can pay back in October. He says the option to make the full repayment of the outstanding 500,000, wouldn't it incur additional interest rates?
So if I understand
Maybe
the
elaborate
question,
on how that works.
yeah. So I think just so that everyone's clear, there's no early penalties if someone does pay off the entire loan amount, you know, any point in the contract. You know, if they want a loan for a month, that's fine. After October 2022, and as you can see on the screen, the interest rate goes up. So it goes from October to February 2023 at 9% fixed, and then thereafter it's prime plus 2. But I think from an investor's perspective, half of the investment is incurring a higher interest rate, where pre-October they're really receiving an interest rate of 4%. So you know, what we're seeing is two types of investors: either an investor who doesn't need a loan and you know simply will take out the loan because during that period they can get better returns somewhere else or returns higher than 4%, and in October they'll then pay off their full loan. Or someone needs a loan and you know they'll pay it off over whatever term they want to, provided it's within 4 years and 6 months.
Thank you. I hope that answers your question, Victor. Feel free to elaborate in the question box. David would like a bit more detail, John T, on the exit plan at the end of the 5-year tax benefit.
Sure. So the obviously we're investing into asset rental businesses, and as I mentioned earlier, and I'll tell you why in a moment this is relevant, we're playing the role of replacing the banks. Okay, so what we have and what we generally incorporate when we invest in a business is the option of preventing the entrepreneur from the 4th year from reinvesting capital into equipment. Okay, so what happens every year, you know, hopefully, and it has been for many years now, is the business makes a profit. A portion of the profit is paid over as a dividend, and the rest is then reinvested into capital. So these businesses typically sign contracts for example, 3 years with their clients, and what will then happen in the 4th year, we can then stop the entrepreneur from reinvesting the capital into new equipment. Ultimately, what we're trying to avoid is the capital being locked into new contracts for 3 or however many years. What then happens is in year 4, cash that's accumulated is then paid out, and then we keep the cash. Okay, we'll then use the cash to buy back our investor shares so they can exit the fund. But not all the cash, there won't initially be enough cash to buy out our investors because there's still intrinsic value left in the companies that we've invested in. Obviously, we're equity holders. So the remaining equity in these businesses, and we try and negotiate this upfront with the entrepreneur, either the entrepreneur will buy us out at a predetermined price, or we'll then reintroduce the banks. So banks on a daily basis are buying asset rental books. It's a very liquid instrument. There's a very simple valuation on how the banks value it, and then we'll simply take the asset rental book and then sell it off to a bank, which will then create liquidity and will allow us to then have the capital necessary to buy out our investors. But I think to give potential investors peace of mind, as a fund manager, we're sitting here because we want a performance fee. We want to really give you a significant return so that we can earn a performance fee, and we only enjoy that performance fee at the end of the 5-year term when we exit our investors. So we're very much incentivized to invest at a low price, to sell at a higher price, and to exit our investors as soon as possible after the 5-year term, so that we could enjoy our performance fee, because that's why we're in this business.
Shanti, how does your performance fee compare to other 12J funds? Do they also operate in this way?
So there are typically two ways. The one way is how we do it, and it's called a gross performance fee. If you invest 100 Rand, if it grows to 120 Rand, we charge a performance fee on the 20 Rand growth. Many other fund managers, what they do is they take the tax benefit into account. So not only will they charge 20% on the 20 Rand growth, they will also charge you 20% on the 45 Rand that you receive from SARS. Some have a hurdle, but ultimately what this does is it erodes an enormous amount of investors' profits. So one of the reasons why our funds are outperforming all our competitors is because they have to perform at an exceptionally high level, much higher than us, just to reach our performance achievements to date. So fundamentally, if you invest in a high fee fund, you're really going to struggle to earn returns.
That's really something to look at for investors. Where do they actually find the information about the fees? Are there any rules about how 12J investments have to set this out, or what questions should they ask? How do they know exactly what they're getting in terms of fees? Because some of these vehicles can be notoriously opaque.
Yeah, listen, I even struggle to understand what competitors charge, having read many prospectuses. So the simple question that an investor should ask is, what are your fees? Okay, and then give me an example. If I invest 100 Rand and if it grows to 120 Rand or 150 Rand or 200 Rand after 5 years, what am I going to get out, and what are your fees going to be? And straight away you'll see. But I think what investors need to ask for is the net returns. After all fees, after all taxes, what am I getting out? And then I think the numbers will be pretty clear.
Thank you. That's really something to think about if you are going into the 12J space. Bruce would like to know, can donations tax also be offset against 12J?
It's a very interesting question.
Yeah, so I would imagine not, because actually I'm not sure how donations tax is accounted for in someone's taxable income. I don't know.
It might be one to pick up with your tax advisor.
Yeah, listen, I've been asked many questions in my 5-7 year career in 12J, and no one's ever asked me that, and I don't know the answer.
Okay, no problem. I'm not sure if you're asked this one often, but David sent in an email earlier wanting to know, can a trust invest into 12J companies? So perhaps just spell out how you can invest in 12J.
Yeah, absolutely. So 3 types of investors can invest: an individual to a maximum of 2.5 million, a trust to a maximum of 2.5 million, and a corporate to the maximum of 5 million. What's quite interesting with the trust, and we're very fortunate to experience this, and so is the trust. So we had in the last financial year a trust that had a huge tax, a capital gains tax event, enormous, in the tune of 150 million Rand. So because the trust was limited to investing 2.5 million Rand, what the trust did was it made a distribution to its beneficiaries, and ultimately the distribution in the hands of the beneficiaries attracts tax. So what then happened is the trust made an investment of 2.5, it distributed X amount to the beneficiaries, and then the beneficiaries were able to invest 2.5. In this case, there were 4 beneficiaries, and plus the trust, so 12 million Rand investment was able to be made into a 12J, and that is an enormous tax saving, close to almost 7 million Rand in tax. So the answer is yes, trust can invest.
Okay, and here's a related question. Moira wants to know, can she invest with her spouse? So is it easy to do that? And could you hit the minimum by investing with somebody else? Perhaps you could just recap on what your minimum is and how you can get to that figure.
Gaurav, I've been speaking a lot. Do you want to? Sure. Yeah, our minimum is 100,000 Rand.
So lower than many of the other opportunities out there.
Exactly. And I think Jonty alluded to it earlier. Why we can do that is because we actually have a fund administration business as well. So we're able to process a large number of investments. I think at the end of February, we processed something like 300 investors in the space of 1 week. So we're able to then set the minimum at a lower place. So with respect to investing together with her spouse, if she means that, are they able to split the tax deduction between them? I think they would need to each come in on their own to get a tax deduction in their own right.
Okay. Why is the minimum lower than other investments?
Yeah, so this in fact speaks to that operational capability. So having that operational capability allows us to do this. But furthermore, we also think it's appropriate. Some funds that are higher risk, tech funds, for example, it's not necessarily appropriate to have a low investment size and have lots of investors that might have smaller investable amounts and hence the ability to lose less. With Infinity being a moderate risk fund in asset-backed businesses, contractual cash flows, we also think it's appropriate to have a low minimum investment size because this can be part of a larger variety of investors' portfolios.
Thank you. Seamus wants to know whether a 12J investment makes sense for lower income earners, and he says a lower income earner is somebody earning around 400,000 Rand per year.
So, I think first thing to note is, if you invest in a Section 12J fund, you're in for 5 years. Okay, so you're not going to have any liquidity during the 5-year term. So if you are you are a lower income earner, you need to be mindful of the fact that you're not going to have that capital available to you. Okay, so if you're comfortable with that, I can only speak personally. So personally, I assess my tax position at the end of each year, and I invest a sum which will reduce my taxable income to 200,000 Rand. Because I feel that anything under 200,000 Rand, the tax benefit isn't significant enough. Above 200,000 Rand, it is, but that's my personal view. So I can't remember what the tax bracket is at 400,000 Rand. I'm guessing between 25 and 30%. So, if you invest 100,000 Rand, you could potentially receive 25,000 Rand back, which is a quarter of your investment. But it's really, it's dependent on each person's personal circumstance.
Thank you for that clarity. Leslie has a question. What is the minimum amount if I take the loan option? So are there minimums?
So the minimum loan value is 475,000 Rand. So in other words, the individual would have to put down a minimum of 25,000 Rand. The fund would then fund them 475,000 Rand, and then they would receive a refund based on 500,000 Rand. Again, back to the previous question is, if you're earning 400,000 Rand and you receive a refund of 500,000 Rand, potentially you'll be in an assessed loss position. We have a tax opinion saying that you will be. I've never done it personally. So you need to then assess, if 500,000 Rand is too much, then potentially the funding option isn't for you, but that is our minimum.
Thank you. And Genevieve asks a question that is asked quite often of these investment opportunities. What happens if you want to exit earlier?
Yeah, so specifically, the fund itself is not like a unit trust where you can get liquidity. You just ask the unit trust provider to redeem your units. The fund itself can only buy back your shares if there's liquidity in the fund, and the directors are then able to do that by purchasing the other investors. So typically, when you go in, you have to understand that you're going to probably be in for 5 years. That doesn't mean that you can't exit by doing a private sale. So you might sell your shares to someone else, and you're allowed to do so. But if it's before 5 years, what this means is that your tax deduction is basically undone in that year. It's added back to your income, so you're going to have to pay tax on that extra income in that year. There's no penalty, there's no interest. So in one way, it's potentially just deferring your tax bill that you would have paid this year to when you sell. But the liquidity would only come potentially from a private sale, and then you'd have to pay back the tax benefit you achieved.
Thank you. And here's a question from Terry. He says, please explain if the 12J option is not going to be available after June, how these 12J companies can continue to be profitable. And that also picks up on a question from somebody else who's just posted in the box about the performance fee that you touched on. If this comes from the tax deduction, what's going to happen to the 12J investment returns in general over the next few years? And perhaps let's look at your fund specifically as well.
So, yes, so if I can answer the last question first. So the performance fee, as I mentioned earlier, if it's taking the tax benefit into account, it's eroding the client's or the investor's return. So I'm not an advocate of investing in a fund where they take the tax benefit into account, because all Section 12J funds offer the tax benefit. So, you know, you would, in my view, and obviously I'm biased, I would consider investing in a fund that doesn't charge those type of fees. To the first question, from a sustainability perspective or profitability perspective, it is a concern for investors should be very mindful that if they invest into a fund that has 5 million, 10 million, or 20 million rand under management, they need to be mindful that the people working in that business need to earn an income. Okay, so what you want to avoid is investing into a fund that doesn't generate enough management income from a management fee to cover costs. So the way to avoid that is to invest with a fund manager, and again, I'm biased, to invest with a fund manager that is sustainable. So as a business, we have 1.3 billion rand under management. For the next 5 to 7 years, we know we'll be earning an income, and we incentivize to stick around because there's a carrot at the end of the 5-year term in the form of a performance fee, and we're very much incentivized to achieve that. So there is a risk investing in a fund that doesn't have much money under management, because ultimately expenses won't be covered if there isn't enough money.
Thank you. And we've got time for 2 more questions. The second last question is from Suzette, who wants to know, can you offset tax against retirement lump sum tax liabilities? There might be one that you have to go to your tax advisor for, Suzette, but let's see. John, do you have any thoughts on that?
Yeah, I do. So when you receive your, you know, when you draw money from your retirement investment, it's taxed within that investment. It's not taxed personally. So before you receive the capital, it's already taxed. So you will then not be in a position to be able to offset your the tax already paid in the fund to against the Section 12J investment. But I think Gaurav may have something to add.
No, you got it perfectly.
I misread you for a moment. Sorry.
No worries, no worries. Yeah, I've got nothing to add there.
So then let's move on to the last question, which is, what are the risks with 12J investment companies? Can you perhaps set out your 5 questions that you would ask if you were putting your granny's mother into a 12J?
Yeah, I'll maybe give you a few, and then Jonty can add if you feel like I've missed out any. So I think the first risk is the risk that a 12J company deploys money slowly. This has been something that a lot of 12J fund managers have been guilty of. And that's because it has numerous bad effects. The first is that as investors, you start getting poor returns because your money is just earning interest. Secondly, you're probably going to be in for longer because the manager now is investing your money in year 2 or year 3. And so instead of being for 5 years, you might be in for 6, 7 years. And thirdly, the manager might be under pressure. There's compliance risks because if you don't invest the money by a certain time, the fund can have fines. And so the manager might be under pressure to now deploy the money into investments that aren't great, that they would have not normally chosen if not for the pressure to deploy the money. So I'd say that's one of them. The second one is something we've touched on quite a bit, which is the performance fees already. So we've talked about that. Is just having opaque fee structures that are very high. So I think that's probably quite a big risk there. And then maybe I'll hand over to you, Jonty. Maybe you've got a couple of other things here.
So performance. So you know what a lot of fund managers are brilliant at doing is marketing their targeted return. And I can think of ourselves and one other Section 12J fund that on their website has their actual return. So you know, understanding what the actual net returns are. And you know, the word net is very important because you know it's very easy to fluff up your returns through a tax benefit. So to really understand your net return, if I invest 100 rand, you know, or sorry, if someone had invested 100 rand 2 years ago, what are they currently sitting on? It's extremely important. And then another risk is to understand the underlying investments. So you know, all 12Js offer a tax benefit, but what they invest in is critical. So you know, if you're very senior in age and you aren't in a position to take a lot of risk, investing into a tech Section 12J fund isn't appropriate for you, in my view. But if you're a lot younger and you are able to take risk, well, then potentially it's an interesting investment. So understanding exactly where your money is going in, and then finally experience. You know, if you are there are lots of 12Js in the market. I think there are 188. Okay. Many of those fund managers have no experience as a fund manager. So if you're going to be investing into a hospitality fund or you know whatever fund in the market, be confident that the person managing your money has experience in doing what they're doing. Avoid sleazy sales pitches and marketing material, and really understand who's managing your money and what is their track record.
So I have
Yes.
probably one more to add to that, which is the risk of exit, which is that because you're investing into equity, into businesses, these funds have to sell that equity in some way. And so if they've invested into a business that's not necessarily, for example, an asset rental business, they need to plan that exit carefully. How are they going to find a buyer for these shares? Is the business going to generate enough cash flows to buy them back, etc.? And the longer that process takes, the longer the investors are going to be stuck in the fund, because they can only get their money out once the fund sells off all its investments.
So lots to think about. One more question. What kind of documentation should investors look for to help reduce the risks of putting their money into the wrong 12J investment?
So, 99% of the market either have something called a prospectus or a PPM, which is a private placement memorandum. This is a thick document and it really explains the investment. They should read that. But if you're not a seasoned investor, my advice is to everyone, go and speak to a financial advisor who has experience with Section 12J and get advice. Because it might sound like a really good investment, but you might not be in a tax position to make one. Or maybe you need to put your money somewhere else. So what you should ask for, just to answer the question, is a prospectus or PPM and an investor statement to see actually what the fund's done from a returns perspective.
Thank you very much. Well, thank you very much to Jonty Sachs and Gaurav Nair of the Infinity Anchor Fund. For more information on this fund, please do go to biznews.com, where we have a special 12J investment section. And we've also got a number of podcasts with 12J investment providers, including Gaurav Nair. So thank you very much. And yes, good luck with your investing.
Thank you, Jackie. Thank you so much.